Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our February 2017 IFRS Insurance webcast. Today's webcast is titled "The IASB Clears the Way Towards IFRS 17 Release, Final Sweep Issues and Guidance." As always, we have structured the webcast with an agenda based on 3 items. The first one will be the highlights of the IASB meeting that took place on Wednesday last week, 22nd of February. Then we'll spend most of the webcast allotted time to go into a deep dive to understand the IASB staff analysis, the discussion that followed, and what tentative decisions the IASB has reached. We'll spend then a few minutes at the end to talk about the next steps. The first of the highlights I want to draw your attention to is the opening remarks that the IASB chairman, Hans Ögerwurst, made at the start of the session on Wednesday last week. He wanted to emphasize that as far as he is personally concerned, this meeting was the last time that the IASB would be discussing insurance contracts prior to the IFRS 17 publication. It's an interesting remark because he made similar comments at the November 2016 meeting, and perhaps he did that without expecting that the fatal flow process conducted by the IASB staff at the end of last year in December would have generated so much material for another board meeting to be called in order to discuss a fairly large number of sweep issues. 2 issues in particular deserved a place on their own. They are the changes in contractual service margin, where the IASB changed their view for the 3rd time in the last 3 months. This is clearly one of the most important elements of the new accounting model, is the decision on what accounting treatment to give to a change in the insurance liability when it happens, and whether it should go to P&L or instead it should go against the deferred profit liability, the contractual service margin. So the unlocking is really what we're talking about, and connected with that is the accounting treatment for experience variances, when the assumptions that an insurance company were set doesn't actually match the actual events in a period. That difference has to go to, again, P&L or other places. What the IASB finalized last week is a new set of simplified decisions and principles that will apply to the unlocking of CSM, bringing back to some extent the original 2013 principles that were changed 9 months ago for the first time in the June board meeting, then changed again in November, and there you go, full circle. In the February meeting, they seem to be brought back more or less as they were at the start. And those principles will effectively make all the changes in the expected cash flows to be accounted for against the CSM, and only experience variances being reflected in profit and loss. The second issue that was tabled with a standalone paper is another very important matter, particularly for those markets like often occurs to be in the European Union, where regulators impose constraints on the pricing of insurance contracts. I'm talking, for example, about the same gender underwriting pricing that is in force at the moment across the European Union for a number of insurance risks. This decision is effectively allowing those contracts that are written by insurance companies subject to those pricing constraints to be grouped in the same group of contracts, even if they have materially different expected profitability levels. Normally, the principle of aggregation that the IASB has approved in the past would actually require those groups to be separate, but because this different level of profitability is enforced by an external factor, the regulation in this instance, then there will be an exemption from that aggregation principle, and you will be able to aggregate the 2 halves of the same portfolio into one group. There was also a final paper with another 36 sweep issues which have been dealt with during the meeting last week. So quite an eventful meeting if you bring them all together, 38 issues in total. And I will tell you a little bit more about some of those issues. It will be a sample. There is no time really to talk about them all, but I will tell you also where to find the papers that can tell you what these 36 additional issues were. So let's now deep dive on the first of the two issues that were tabled as separate papers, the changes in the CSM. And the paper actually covered, if you like, a number of items associated with the accounting for the CSM. The starting point of the analysis that the staff conducted is to reiterate the ISB objective, which is to avoid, with the principles around CSM accounting, to avoid that gains and losses are recognized in the current period due to the experience adjustments that may be occurring in that period and the impact on future estimates cash flows, which are connected or consequential to the fact that there are such experience adjustments, and have then gains and losses in future periods when a claim is incurred earlier or later than expected, reversing to some extent what was the accounting of gains and losses in the current period. So that is deemed to be an unsatisfactory presentation of the performance of an insurance business. When they dealt with this issue and tried to implement this objective in the November 2016 meeting, they concluded that experience adjustments and the related change in the present value of future cash flows should be combined, and this combined amount must be recognized in profit or loss. However, the staff identified that there are many insurance contracts in which there is no offsetting correlation between experience adjustments and the future estimates of cash flows, and that creates a problem, because that means that this principle, this solution identified in November actually doesn't work. In addition, the identification of such situation would create some undue operational complexity. As a result of this analysis, the staff concluded in their paper that it's more appropriate to reverse the November 2016 decision, which required insurers to measure the experience adjustments and related changes in present value of future cash flows together. The analysis of the situation that experience adjustments and changes in present value of future cash flows can create in the financial statements of an insurance company goes on to analyze how such experience adjustments are defined currently in the draft IFRS 17. The draft doesn't make any particular distinction as to the component parts of the expected incurred claims and expenses and the actual incurred claims and expenses, and experience adjustments is defined at the moment merely as the difference between these two numbers. This definition doesn't pay any attention about the presence or absence of an investment component. Now, the analysis presented in this paper from the staff considers that a delay or acceleration in the repayment of such deposit component, such investment component, would lead to gain or loss in the related period that is automatically offset in future periods through the CSM release. That is, again, not deemed to be a faithful representation of the performance of the period, given that the cash flows associated with the investment component are certain to be paid sooner or later. And the analysis would then lead the ISB staff to conclude that a change in the investment component should not be part of the definition of an experience adjustment, and it should not therefore be reported in profit or loss. With that analysis, the recommendations that the staff put forward for the vote of the ISB was broken down into 5 components. The first component is that for contracts that are measured under the general model or the building blocks approach, all changes in the estimates of the present value of future cash flows arising from non-financial risks are always going to be adjusted against the CSM. For contracts which are measured under the variable fee approach, all changes in the estimates of the present value of future cash flows that are unrelated to the underlying items and that arise from non-financial risks are adjusted against the CSM. So please pay attention. You can see that there is effectively here the execution of the same principle across the 2 subsets of insurance contracts. And the principle is non-financial risks changes in assumptions. These are really, in a more colloquial language, the events that the ISB staff is recommending to book against the CSM. In other words, we're going back full circle to the original principle, which we all supported, that if you're changing the assumptions in the future cash flows, those changes in assumptions must be booked against the deferred profit rather than taken to P&L. For the variable fee approach, which is something new that did not exist in the 2013 express draft and therefore requires special treatment, you have to make a distinction. The underlying items do adjust the CSM, and the underlying items contain both financial and non-financial risks. And that's why for the variable fee approach, the qualification that the recommendation sets out, as represented in the slide, is very important. The third component is that changes in estimates adjusted against the CSM include changes directly caused by experience adjustments. There are two exceptions. Where the change relates to incurred claims, that will always go to P&L. As we know, incurred claims are past the coverage, and everything that is past the coverage doesn't adjust the future deferred profit, because the only service that the ISB accepts is delivered, and therefore the only service that actually carries profit recognition and revenue recognition is the underwriting stand ready obligation. The obligation to stand ready to pay claims. When the claims is incurred, you then move into the incurred phase, the claim standing phase, for which there is no CSM. And of course, when the changes that trigger a non-onerous group loss will effectively exhaust the CSM and then report into P&L any additional amount that could not be absorbed by the brought forward CSM balance. Equally, if you are in a non-onerous situation and you have already reported a non-onerous loss and you are reversing that, again, the reversal of the loss component is immediately recognized into profit or loss. This is the part of the decision that actually is not new, and it was recommended for confirmation. Then we have the change in the definition of experience adjustment to exclude investment components, which I explained earlier. And finally, not necessarily a direct relationship to the unlocking of the CSM, but the staff also concluded that the amount of the CSM for a group of insurance contracts should be recognized in P&L in each period by allocating the carrying amount of the CSM after all other adjustments have been made to the carrying amount of the CSM at the start of the period. And we're moving away from another decision that was previously taken by the ISB to do all these adjustments on the CSM balance at the end of the period, which required constant truing up of the CSM amortization value. This approach is perhaps not as precise if you want to measure overall in the 12 months period, but is far more practical to ensure that each reported profit and revenue on an interim basis can add up then quarter by quarter, 6 months by 6 months to the full year without having to change previously reported numbers. And so from a Deloitte perspective, we certainly welcome these, and indeed we have recommended that change. So we were pleased to see that recommended. Now let's have a look at the discussion. The first discussion was around the general model and the changes in estimates of future cash flows that are directly caused by experience adjustments. Here we noted that there was general support for the staff recommendation. One board member noted that obviously there is no perfect solution given the past decisions. Another board member said in his view the staff recommendation was quite simple, easily understood solution, and for those reasons he felt it was pragmatic and should be supported. Then the board moved into the discussion of the determination of the amount recognized in P&L to reflect the service provided in the period. The last of the 5 recommendations discussed in the previous slide. Here, one board member, I would call this board member perhaps a purist, an accounting purist, disagreed with the staff recommendation because he felt that this proposal would actually result in some inconsistency on the recognition of the amounts of insurance revenue, and that could also have some significant effect on the reported profit. But other board members were actually disagreeing with him and effectively rebutted his position by saying that this was a very practical solution and they were personally supportive of what the staff was recommending. Another board member noted that the need to be clear about the treatment when changes in estimates are made subsequent to the reporting interim results is important, and he suggested that in the final draft perhaps some words are added to the text to make that clear. The debate then moved on the proposed revision of the definition of an expense adjustment. Again, there was general support on the staff recommendation. Several board members identified areas where they could see some potential for a more effective way of phrasing certain aspects of the recommendation, and the staff took note of all those proposals, and they will be dealt with in the next few weeks as the staff continues to work on the polishing of the text of the standard. This is now in progress, and with the beginning of this week, the staff is already working on refining all the various paragraphs of the final text of IFRS 17. On the last of the 5 topics, the contract measured under the VFA, which was presented as the second bullet in the slide with the recommendations, there was hardly any discussion. That was effectively confirmatory in the staff paper rather than proposing a change, and the board was comfortable to confirm that for VFA the matter was clear and approved in previous decisions. So when the chairman called for the vote, it was a unanimous support for the recommendations. 12 board members out of 12 voted in favor. The meeting then moved on to the second paper, the one that talked about the narrow exemption for grouping of regulatory effective pricing of insurance contracts. And the analysis of the staff started back in the recent history of the project, when in January last year, the ISB for the first time finally landed on the principles around the level of aggregation of insurance contracts. That decision was predicated very much in the analysis of the relative profitability of contracts sold in an entity. The staff observed in their analysis of the matter that since that decision in January 2016, there's been a significant amount of change in the level of aggregation principles, and effectively the journey that landed with the decisions approved in November 2016 is quite a remarkable one. In the space of 10 months, the ISB moved from a very demanding, highly granular application of the level of aggregation principle to one that is perhaps, I can say that, more measured and produces still a number of groups, but in a far smaller number of items than the original decision would have created. Now, based on the recent decisions, the staff analysis proposed that this aggregation could result in recognizing onerous losses immediately for policyholders with a particular characteristic, whereas profits will be recognized over the coverage period for policyholders with a different characteristic, so a male policyholder versus a female policyholder, for example. Observers that have been consulted over the last couple of months pointed out that these may be hard to explain when risks are pooled in the same portfolio within which those two groups are created. Now, we need to remember here that in the November decision, the key principle of groups being very much connected with the definition of a portfolio was clarified. And that was clearly an improvement from previous decision. There is now a clear correlation to the pooling of risk in a portfolio and then the slicing of that portfolio into individual groups for reporting profit in the financial statements. And it is in the context of that portfolio then the imposition of a pricing constraint can create some counterintuitive numbers to be reported. On the grounds of this analysis, the recommendation from the staff was that an entity should be exempt from the requirement to divide the portfolio into groups of contracts, as described in the November decision, a group that is onerous at inception, another one that is not significantly likely to be onerous, and the rest. And it should be allowed to apply the requirement by combining those different groups of differently profitable contracts into one single group if and only if there are specific constraints in law or regulation on the practical ability of that entity to set a price or benefit levels that vary in accordance with the policyholder characteristics. In that instance, there is an option for this entity to group together those contracts into a single group. This is an option, is not a requirement. And finally, the recommendation is that this exemption must be worded in the final standard such that it should not be extended by analogy to any other regulatory affected transaction. As the discussion started on this paper, there was clearly visible general support for the staff recommendations in the narrow circumstances described. One board member, however, warned the board against providing too much detailed guidance, particularly as regulatory requirements often vary in different jurisdictions. And so when the vote came, it was not surprising for us to see that there was one vote against the staff recommendation with 11 board members supporting it. And that was passed with a vast majority, as you can see. I would like now to move into the third fairly large paper that contains all of the other sweep issues. So we are talking about three buckets of issues. The first one, which also included the two issues already presented with separate papers, counted 14 issues. These are the issues that resulted in a change in the text of the draft IFRS 17 that was circulated for fatal flaw comments in December last year. In addition to the two issues that I already presented because they were tabled with separate papers, I will talk about another three issues that are included in this paper. It's paper 2C, which you can download from the ISB website if you wish. The second bucket is a group of 15 issues for which the ISB staff propose clarifications to the draft IFRS 17. So this is additional text, yet is not changing an existing principle or guidance, is perhaps strengthening the text in the standard to ensure that there is clarity of interpretation of what that guidance is. I intend to comment on 6 of these 15 issues in the following slides. And then the final bucket are 9 issues. These are the ones where the staff has recommended to the ISB to do nothing. They are listed and you can see what they are. I will talk about 2 of those where the recommendation was to leave the guidance as it is, and I will explain what that guidance is against the proposed change of the recommendation. So let's begin with the first of the 3 that led to a change in the text of IFRS 17. Mutualization. It's something that we have commented before as we were reporting back to you on the November meeting. They had agreed to include some guidance. The fatal flaw resulted in a number of reviewers indicating that the guidance on how to account for insurance contracts with mutualization features, that is, payments made to or from other insurance contracts as a result of contractual requirements. The recommendation was that that guidance should be written. However, it will be written outside of the mandatory part of the standard. So it will not be in the body of the standard, it will not be in the application guidance or one of the mandatory appendices. It will be included in the basis of conclusions. These new paragraphs will clarify how these requirements interact with the requirement that only contracts issued within 1 year may be grouped. And in particular, we'll explain that if mutualization is in place, then the 1 year group doesn't actually bind you from the unlocking adjustments, and the unlocking adjustments is effectively carried out by taking into account all the groups with in-force contracts that belong to the same portfolio. The next one is on the premium allocation approach, or PAA, where we got some decisions here on how to treat investment components. The analysis of the staff indicated that under the current draft, there was a prohibition to use the PAA if the contract contained an investment component. And a number of reviewers of the fatal flaw draft suggested that that was inappropriate. And so the staff agreed with that and recommended to extend the use of premium allocation approach to those eligible contracts, even if they contain an investment component. However, the premium allocation approach now changes, and similar to the building blocks approach, to the general model, you will have to disaggregate the investment component as you present and measure insurance revenue and insurance expenses. So a wider application of the PAA, but with a new, fresh requirement, which will make the PAA less simple. The third one, in terms of changes to the text, is around the contract boundary. And what the staff said here in the analysis that there are comments which indicated that the frequency of assessment on what the boundary is for a contract was not clear. And so in their analysis, they concluded that if there is a substantive obligation to provide coverage, which is underpinning a particular contract boundary, and the price level, and the benefit levels, etc., then this assessment must be up to date at each date you are reporting insurance contracts. So the recommendation is that the contract boundary is not set at the inception of the contract and then never changed. It's actually an element of the measurement that remains current. And that means contract boundary must be reassessed at each reporting date. And if there are changes in circumstances that make the contract boundary longer or shorter, those circumstances will have to be reflected, and the contract boundary will have to be reset to what is going to be the appropriate number of years that will emerge from the analysis of the new circumstances. So a clarification, which is fairly important in terms of the practicality of implementation of systems to make sure that something is in place within your actuarial models or your sub-ledgers to ensure that the reassessment of the contract boundary is part of your working day timetable. Moving then into the clarification bucket, the first one I wanted to bring back to you is the level of aggregation, where the staff proposed some clarification on what to do on day one. The draft IFRS 17 that was circulated at the end of last year led a number of reviewers to question whether there was effectively a requirement to calculate on a contract-by-contract basis the best estimate and the risk adjustment in order to establish if those contracts on an individual basis were onerous or not, on the grounds that the principle set out since the November meeting was to create groups that only contain onerous contracts. So these are groups effectively with no CSM whatsoever. Now the staff agreed that perhaps there was ambiguity or lack of clarity, and so they proposed some clarification, and the clarification will effectively make it clear that if you have a system in place as an entity, as a company, that allows you to be absolutely certain that within your groups that are supposed to be with CSM, there are no contracts without CSM, i.e. that are individually onerous, and vice versa, that you can create the onerous group of contracts, knowing that within that group there are absolutely no contracts that are individually with the CSM, then you don't need to calculate those contracts individually. You can use that system, whatever that is. And the standard is going to tell you. It's not going to tell you what that system is. It's going to leave you to your devices to figure it out. But if you cannot have that system, then I'm afraid you will have to calculate on a contract by contract in order to determine in which of the groups those contracts will have to belong. And this is non-negotiable. The standard will make it clear that the offsetting of gains and losses on day one is absolutely prohibited, and this is one of the key aspects of IFRS 17. So there we go. We have the clarification that we were looking for. The second point on the level of aggregation that was clarified is around recycling on the recognition. One thing that some commentators observed is that if you are using as a policy the separation of the discounting effect between P&L and OCI, you will have an accumulated OCI balance. And the standard apparently did not reflect what to do on the recognition of a contract. Was there a need for recycling or not? Now we have an answer. The answer is twofold, and it depends really on what technique you have chosen to report into P&L the finance income and expense from insurance contracts. If you're using the effective yield or the crediting rate approach, then it becomes a straightforward recycling on the recognition, similar to what you do for financial assets like bonds that are reported at fair value through OCI. You sell the bonds, the accumulated OCI balance is recycled into P&L together with the gains and losses emerging on sale. Similar situation here for this first solution. You will recycle into P&L the accumulated OCI balance associated with that liability. However, if you are using the current book yield approach, then you cannot recycle the OCI, because the current book yield approach is effectively already designed to match the movement of gains and losses on the associated assets in the P&L and OCI. And so for that reason, they are not asking for the recycling of the balance in the event that the contract is derecognized. It's questionable whether this is a perfectly valid solution, and I know that we have a question on that, which I will perhaps take later after the recorded session is complete. The next clarification is on the variable fee approach, the VFA criteria. The analysis here indicated that several reviewers recommended clarification and particularly clarity on the wording that supports the interpretation of contractual terms. These are the key words in the first criterion of the 3 VFA criteria that identify what are the items that belong to this pool, creating the underlying items that will then feed into the VFA accounting approach. The staff agreed that clarification was necessary, and what they have now recommended is that there should be, throughout the entire body of IFRS 17 guidance, a principle to always explain that the reference to contractual term includes the substantive rights and obligations that an insurer will have from contract, law, or regulation. And so effectively we have now a clear guidance explaining that contractual terms have to be interpreted in a broad sense. It's not just strictly speaking terms contained in the policy document, but also if they are not included in the policy document, but they are part of regulation or legislation, those will still be enforceable obligations which can create the specific pool of underlying items necessary to qualify under the VFA criteria. There is an extract of the new revised text in Appendix B of Paper 2C of the February 2017 ISB meeting, which, again, if you are curious to find out, and if it does apply to your business, I would recommend you download from the ISB website. Another clarification on VFA was on the simplified transition approach. Some reviewers recommended clarifications on this approach. This is the one that applies once you have reached the point where you can no longer fully restate VFA contracts, and it becomes impracticable to carry out the normal restatement of past transactions. At that point, the standard will give the option of choosing the fair value approach or the simplified approach, and if the contracts being restated are VFA contract, there is a specific VFA simplified transition approach, which actually has been reproduced in full, is paragraph 16 in the appendix in the table of paper 2C under item B9, which explains effectively that you can use then the fair value of the underlying items for those contracts that cannot be fully restated, and then explained also which historical cash flows, and only historical cash outflows that do not reduce the underlying items will need to be added back to the best estimate liability calculated on the 1st of January 2020. And then also explains how to use a simplified calculation for the CSM that has been earned effectively from the inception date of the contract to the transition date of the balance sheet that you are preparing. It's worth reading if you are anticipating that you will have an impracticability point in your restatement activity, because this could be a much more interesting solution than just fair valuing your VFA contracts. Another clarification is around the coverage unit. The analysis here is that several reviewers, we count Deloitte among them, recommended the inclusion of a definition of this important concept and the addition of guidance to make sure that there is a consistent application of the underlying principles around the world. The guidance will be there in the standard, but unfortunately the recommendation is not to add a definition. Hopefully this is not going to be a big deal. the guidance will be clear enough in the body of the text of the standard, and the only thing we're going to miss really is a term in the Appendix A, which is the one that will carry all the definitions and having the coverage unit not featuring in the glossary of the IFRS handbook. Hopefully that is not going to be a major loss, and the guidance will be what really will be helpful for everyone to understand. Clarification also on the assumptions around inflation. This is an interesting one. Reviewers were conscious of the fact that the standard text in the draft released last December for comment contains some ambiguity around inflation. And this is very important because the ambiguity was as to whether or not inflation was to be treated as a financial variable or a non-financial variable. If you are a financial variable, under the CSM accounting principles, you cannot take that change in the liability into account, and you will have to book it into P&L or OCI. But if it is a non-financial variable instead, as confirmed also by the sweep issue paper this past week, you will book the change in the future cash flows always against the CSM if there is an expired coverage. So it's a really important distinction. And what we got as a recommendation is effectively two scenarios. One is inflation as financial, and the other one is inflation as non-financial. So when is financial? Inflation is financial when it's based on an index of prices or rates or on prices of assets with inflation-linked returns. In that case, inflation will be treated as a financial assumption, no CSM unlocking. Inflation will be non-financial and therefore will trigger unlocking of CSM when it's based on an entity's expectation of specific price changes. So that's it. It's quite clear now what it is. Ambiguity is gone, but perhaps we have now to face more volatility into P&L or OCI because some of the inflationary assumptions that actuaries make about the future cash flows may actually be deemed financial as a result of this clarification. Let me now cover the last two items of these very long paper 2C list of sweep issues. The first one is the locked-in accretion rate for CSM. There was a proposal, there's been a proposal for some time actually, to avoid the requirement that the accretion rate for CSM for all contracts except those that are accounted for under the VFA should be locked in on the market rate that applied at initial recognition and never changed ever after. This recommendation again was put forward by a number of reviewers during the fatal flow process, but the staff recommended not to make any changes at all, and so to reject this proposal to unlock the accretion rate for CSM. And the reason that has been given in the paper is that no change will be made on this because the CSM is not a future cash flow, and the amounts that are used on initial recognition to determine the CSM are not updated for changes in discount rates other than in the event of accounting for that contract using the VFA. And so for that reason, the accretion rate must be locked in at the same rate that applied on day one. The other one for which no action was proposed is on the guidance that some reviewers requested for mutual insurers. The ISB staff proposed no guidance to be added to the IFRS in compliance with the overarching principle that informs all IFRSs that they are standards designed to give guidance on transactions accounting, not on the entity accounting. And so they are not going to be adding guidance for mutuals because that's just a type of entity issuing insurance contracts. The one thing we should look for later on is some educational guidance, which is non-binding, and some implementation guidance, perhaps through some form of publication that the ISB may either release directly or sponsor through collaboration with other institutions. Moving then to the discussion, the protocol that the staff proposed for this long paper was to discuss any of those 36 issues on an exception basis. So the ISB member had to raise their hands and say, I want to discuss a particular issue. There was actually no such an event. There were some comments, so the session was not so short, but the key point that we noted is that the ISB was noting down some wording that the IASB is now taken on board and will be used for the finalization of the text of the standard. Other than that, everyone was happy with this suite of issues and recommendations, and the vote, once called, was unanimous in support of all the individual recommendations that the IASB staff put together in the paper. I just want to share with you that in terms of the wording changes, we noted that a number of them came on the mutualization recommendation we talked about earlier, the VFA criteria that we talked about earlier, and also the meaning of contractual terms also covered in this webcast. The final message for today is around the next steps. The drafting and the polishing of the text for publication of IFRS 17 has now begun. There is an expectation for this process to be completed in the first half of this year. And in fact, if you look into the IASB official technical plan, which has been released earlier this week, you'll find that they've actually put a more precise expected publication date, that being May 2017. So we got another couple of months and a bit to wait for before IFRS 17 is going to land on our desk in all its glory. With that comment, I would like to draw the recorded part of our webcast to an end and open the floor for any questions.